Hello and welcome to Pro Trader Strategies market commentary for Wednesday, May the 13th. I'm Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic and the geopolitical environments, how that's going to impact the overall markets. Well, I do the same thing in these daily market commentaries, but I layer on top of it option strategies I find in order to increase that overall yield in my portfolio. And I go into, in my webinars, so I got one tomorrow on the broken wing, I drilled down on somewhat of a roadmap in order to implement these options into our portfolio. You can't just go out there with a bullish assumption and buy calls every single time. It doesn't work that way. And I go in there and I try and make it a little bit easier to understand options trading so that I kind of lift the mystique away from options, because I think it is one of the more important things that we need to understand in trading in order to increase that overall yield. It increases your probabilities of success. There's no doubt about it. All right, without further ado, let's get on with that economic data. Across the pond, we got some important economic data last night, and I don't usually talk about day-old economic data, but it was so surprising, and it came out of Great Britain. We had GDP, which is gross domestic product, coming in better than expected. I mean, it is negative at negative 5.8, but it was expected to be a negative 7.9, which all of these came in better than expected. Same with construction output, negative 5.9, expected to be negative 7.1. Manufacturing production came in at negative 4.6, but was expected to be a negative 6. So a lot of those industrial production came in at negative 4.2, expected to be negative 5.5. So, and business investment came in unchanged. It was supposed to be a negative 0.3. So all of those numbers came in better than expected. Yeah, previous numbers revised a little bit, but not too much to really talk about there. So surprisingly well out of Great Britain, despite the fact that we are still don't get me wrong, it's bad because it's all negative, but better than expected and better than I would have thought as well. Here in the United States, we got our own PPI, core PPI came in at negative 0.3%. That strips out food and energy. This is producer price index. And then the regular PPI came in at negative 1.3. That's putting back in food and energy. Now, we know what's happened with energy. We can see it right here on the chart. Crude oil has fallen quite dramatically in that time. So that is a price that would pull that number down. One thing, though, I think that we're going to see that number start to come up a little bit. The reason why is because we're seeing on the food side of it, especially on meats, that those prices are starting to creep up because of there's a lack of the slaughterhouses are basically closed down, Tyson and many of the other ones. So there's a bit of an issue where we have a lot of these cows, pork, chicken are not getting processed. So there's a lot of farmers out there that are starting to struggle now as well because they can't offload that inventory of their animals. So we're going to have to see how that works out, but we're seeing at the grocer those prices go up, and at the producer level those prices come off a bit. So a bit of a tailspin on that. We also got crude oil inventories coming in at a drawdown of 0.7 million barrels or 700,000 barrels of oil. It was expected to be a build of 4.1. So starting to see some of that supply come off a little bit as we are seeing some of the demand starting to come back a little bit, but some of that supply is coming off a little bit as we're seeing a lot of these oil producers start to shut down. We talked about it yesterday with Chesapeake Bay maybe filing for bankruptcy here pretty soon. All right, and that's about it for the economic data. How are the overall markets reacting? Well, crude oil still struggling to get above that $26 a barrel mark. That is becoming a very defined line of delineation. It hasn't been able to settle above there despite the fact it's tested it several times. And we would expect if we get above that line, I think we're going to maybe see a bit of a pop back into the 30s. But at this point in time, I don't think that we're able to get that momentum going as there's still a lot of uncertainty in the United States and quite honestly across the pond how this coronavirus is going to affect people when we start opening up a little bit more. So we'll have to see how that starts going forward. We here in Arizona are starting to open up restaurants. A lot of people are making you wear masks while waiting in line and things of that nature. So we'll see how that all goes. All right, gold is up about $8. We stayed above that 1,700 a troy ounce mark yesterday. Looks like we got above that 9-day simple moving average. It was very close. That is short-term bullishness. Today we're above that. It looks like we're pretty solid there. I think we're going to hold on to that just because we're seeing some sell-off. We talked about this yesterday with Powell speaking today. He didn't give the markets a whole lot of a comfort, really, and the markets really have started to see some weakness as the day goes on. Now, there's something to talk about there as well. Giving me a minute, we got back into the 80 handle. I talked about this. Anytime we get below that 180 handle in the bonds, you're going to see some buying pressure coming in. And I think we're going to stay between 183 and 180 for the foreseeable future. Now, there's going to have to be some really major shakeup in order to get that to change. To get above 183, I think we're going to start having to see some real spikes in this coronavirus. And if we start seeing this economy start to, flourish a little bit as we start to open up, I think there's a lot of people that have cabin fever and are going to want to get out to the restaurants and things of that nature. And then in that case, we could see the bonds come back down a little bit. But for the foreseeable future, I think that we are going to build this area and create a point of control right here in and around that 180 area, which is kind of lining up to be about 181 and 180 and change, very close to it, just a couple ticks away at this point. As you can see right here, it's basically, I can try and nail it, about 180 and a half, let's call it. All right, the VIX is spiking today up into the 30s again. We got up into the 30s yesterday with that sell-off, so we are back into the 30 handle. That's because we're starting to see the equities really sell off. You can see the Dow Jones near at least the lows of the day, down 470 points. Just pretty much since the market has opened, we got a bit of a bounce, and then the markets just kind of fell on their face. As you can see here, out of the 9,000 handle with the NASDAQ, down 175 points. Now, I talked about this. I'm a little bit worried about this upside move in equities. It just seems bubblicious, for lack of a better word, almost as bubblicious as near 2000 kind of things, where we've gotten way ahead of ourselves. I have been really going back and forth today about just completely flattening out my positions across the board. And that happened a little bit late. I sold into some strength earlier today with the opportunity to roll out some short covered calls in MasterCard, but then the market really started falling quite dramatically, and seriously, I'm kind of juggling this. I want to wait until tomorrow and see if we get a bit of support down here and maybe get a bit of a rebound or something. But I've talked about this. This market has made quite a dramatic move even during the lockdown. And yes, it is forward looking, but at the end of the day, have we gotten ahead of ourselves? And if the market really wants to correct, I don't want to be having these positions that are really working nicely, not work anymore. So we got the E-mini S&Ps off by about 57 points. We are still in a trending upward pattern here, which has enabled me to hold on to this trade. We haven't really broken any major support levels. Now, this is what I was talking about. Powell started speaking, and we started getting a bit of a rally, but then boom, just flat on our face. As you can see, it has been pretty much unabated. Maybe there's a lot of people out there that are thinking like I am with this getting a little overdone to the upside. So let's talk about some trades that I've done. GLD, I am working to get out of this. I'm very close to 50% of my max profit in this. If you guys remember, I did the iron condor in there, and it's in the June. So I bought the 146, sold the 151 puts, and then did the short 173 calls, and then long the 178 calls in there. So I'm trying to get out of that, close to 50% of my max profit. I do expect us to trend sideways in gold, but if we see a major sell-off in the equities, we're going to see a pop, and that's going to probably breach some of my my short calls there. So I don't want that to happen, because we could easily see this market, especially with the way that the Fed has been printing money, that the gold bugs will really drive this higher. So I am trying to get out of this trade right now in GLD. The other thing I did was in MasterCard. On that bounce early this morning, we got a bit of a rally in there, and I rolled some of my calls out. Excuse me, my short calls that I had on out in time, rolled out and up, as a matter of fact. So anytime you can do that, where you can roll out and up in time, is what you want to do there. So I've done a lot of work with this trade here, and have done several things with trying to lower my overall cost basis on this. If you guys remember, when I got put these, I got put it the stock at 270, and then I got put the stock again at 215. Some of those got called away from me at 245, but I've lowered my overall cost basis just at a quick glance here on this total trade for about, let's say, 1, 2, 3, 7, 8, 9. I'm lowering my cost basis on this by close to $10 by rolling out from selling those 270 puts, getting those put to me. I get to keep that credit. Sold some 215 puts, collected a nice credit for that, got put those stock, and then started selling the 300 calls against all of that. Rolled that out again to the 240 calls, or sorry, the 245 calls. If you remember, that's the ones that got called away from me. So on the lowering of that cost basis. Then I got that big rally, sold some 290 calls for another $1.13. Well, those 290 calls I just rolled out in time. The May 290 calls I rolled out to the June 300 calls. So I rolled out and up. So anytime you can do that, that is a great winning trade. That's how we want to do these covered calls, is roll them out in time, collect a nice credit, go back out to that 16 delta, which is what I did in this trade, and collected another $2.13. So I'm well over lowering my cost basis on these by $10. Right now I'm long at 270 in my position, because those 215 calls, or the 215s that I was long to dollar cost average, got called away from me at 245, like I mentioned. But overall, I've lowered my cost basis quite dramatically, and now I rolled out to those 300s. Again, anything goes here. Market starts looking a little bit ugly. We start breaking some support levels. I'm going to be very close to pulling the ripcord on a lot of these. All right, so keep your eyes out for that. You know, I do still believe that my position, all my portfolio, is based around this coronavirus, and I think that those are very secure. You know, I got Microsoft, I got Walmart, which I covered some of those in my short calls in Walmart. With that being said, I think Walmart and Target and those are going to do very well in this environment. MasterCard, like I mentioned, that one's I've been talking about. I'm a little bit nervous about this, and people start really racking up their credit, right, and can't pay that off. That's one that isn't really insulated by this coronavirus. EA Sports, but a lot of those that have had those big moves are in the NASDAQ, and we saw NASDAQ is probably leading the way to the downside. So I might take some of my profits and run. One thing I did notice when I was just flipping through the book here, if you guys remember on this Thor Industries, they make the JCO, and I got into this at 38. I sold out of these at 77, which was very close to the high right here on this day. You can see I didn't quite get the high, but it was pretty darn close. 77.12, and I did it because of that gap that we just jumped up. I felt like the shorts just got handed and dumped out. Now we've completely retraced that, so great timing on getting out of that by about $10 better. So very happy about that. Anyway, I don't know what happened there. It kind of froze up on me for a second there, but that's all I really have for you guys today. Couple of other things. Check out the webinar tomorrow. We're going to be doing it on the broken wing butterfly. I'm going to show you how to build that out in order to get the right environment, the right strike location, all of those things. It's not just like going online and finding out how to build it out. They don't give you the correct strike locations, or at least a roadmap to figuring that out. So check that out. And last thing I got, please remember, we are an educational company. Past performance of any trading system or methodology is not necessarily indicative of future results. So please take a moment to go over that. That's all I got for you, other than if you can't take that, take it easy.